Chapter 4. Security and Collateral Pledges, Mortgages, Guarantees, and LTV. Introduction to Security and Collateral in Corporate Lending. In the realm of corporate finance, the extension of credit is a fundamental activity that fuels business growth and investment. However, lending is not without its risks. Lenders face the possibility of default, where a borrower is unable to meet their debt obligations. To mitigate this risk, lenders often require borrowers to provide security or collateral against the loan. Security is a broad term that refers to any interest in property that is given as a performance guarantee for an obligation. Collateral is a specific type of security, representing a tangible or intangible asset that a borrower pledges to a lender to secure a loan. If the borrower defaults on the loan, the lender has the legal right to seize the collateral and sell it to recoup their losses. The presence of high-quality collateral can significantly reduce the lender's risk, often resulting in more favorable loan terms for the borrower, such as a lower interest rate or a larger loan amount. This chapter provides a comprehensive overview of the different types of collateral commonly used in corporate lending, including pledges, mortgages, and guarantees. We will also examine the concept of the loan-to-value ratio, or LTV, a key metric used by lenders to assess the risk associated with a collateralized loan. Section 1. Types of collateral. Collateral can take many forms, and the type of collateral accepted by a lender will depend on the nature of the loan, the borrower's creditworthiness, and the lender's risk appetite. First, pledges. A pledge is a form of security where the borrower delivers possession of an asset to the lender while still retaining ownership. The lender holds the asset until the loan is repaid in full. If the borrower defaults, the lender can sell the pledged asset to recover the outstanding debt. Examples of pledged assets include securities such as stocks, bonds, and mutual funds, cash deposits in a bank account, inventory including raw materials, work in progress, and finished goods, and receivables, which are invoices owed to the business by its customers. The legal framework for pledges is well established, and the rights and obligations of both the lender and the borrower are typically set out in a pledge agreement. This agreement will specify the terms of the pledge, including the description of the pledged asset, the loan amount, the interest rate, and the conditions under which the lender can take possession of the asset. Second, mortgages. A mortgage is a legal instrument that creates a lien on real property. Unlike a pledge, the borrower retains possession of the property while the lender holds a security interest in it. If the borrower defaults, the lender has the right to foreclose on the property and sell it to recover the outstanding debt. Mortgages are commonly used to secure loans for the purchase of commercial real estate, such as office buildings, warehouses, or retail spaces. They can also be used to secure loans for other purposes, with the borrower using their existing property as collateral. Third, guarantees. A guarantee is a promise by a third party, known as the guarantor, to repay a loan if the borrower defaults. Guarantees provide an additional layer of security for the lender, as they can pursue the guarantor for repayment if the borrower is unable to meet their obligations. Guarantees are particularly common in corporate lending, where a parent company may guarantee the debts of its subsidiaries, or where a business owner may personally guarantee a loan to their company. The strength of a guarantee depends on the financial strength and creditworthiness of the guarantor. Section 2. Loan-to-value ratio. The loan-to-value ratio, or LTV, is a critical metric used by lenders to assess the risk associated with a collateralized loan. It is calculated as the loan amount divided by the appraised value of the collateral, expressed as a percentage. For example, if a borrower takes out a loan of $1 million secured by property valued at $2 million, the LTV ratio is 50%. A lower LTV ratio indicates lower risk for the lender, as there is a greater cushion of equity in the collateral. Conversely, a higher LTV ratio indicates higher risk, as the lender has less protection in the event of default. Lenders typically set maximum LTV ratios for different types of collateral. For example, a lender might require an LTV of no more than 70% for commercial real estate or 50% for inventory. These limits help to ensure that the lender has adequate protection in the event of a decline in the value of the collateral. Section 3. Collateral Management Best Practices. Effective collateral management is essential for mitigating credit risk and ensuring the smooth operation of a corporate loan portfolio. This requires robust systems and processes for tracking, valuing, and managing collateral assets throughout the loan lifecycle. Key best practices include maintaining accurate and up-to-date records of all collateral assets, conducting regular valuations to ensure that the collateral value remains sufficient to cover the loan amount, monitoring the condition and location of physical collateral, and establishing clear procedures for taking possession of collateral in the event of default. Modern loan management systems play a crucial role in collateral management, providing automated tools for tracking collateral, calculating LTV ratios, and generating alerts when collateral values fall below acceptable thresholds. This concludes Chapter 4, Security and Collateral Pledges, Mortgages, Guarantees, and LTV.